these truths to be self-evident.
That all men are created equal.
As a member of Congress, I get to have a lot of really interesting people in the office, experts on what they're talking about.
This is the podcast
for insights into the issues.
China, bioterrorism, Medicare for all, in-depth discussions.
Breaking it down into simple terms. We hold
these truths
with Dan Crenshaw.
The Eagle has landed.
Welcome back, folks. Today we have a great episode on the economy and some of the major economic and fiscal issues that could be impacting the nation over the next couple of years. Now, there are some signs that inflation is easing, but it is still far too high. And we have Biden's regulatory overreach that has been a significant barrier to boosting growth and normalizing the economy. In addition, out-of-control spending poses another threat to our long-term prosperity, and we're on the verge of a major impasse over the debt ceiling. Probably no better expert to discuss the intersection of these issues than our guest, Douglas Holtz-Eakin, served as both director of the Congressional Budget Office and chief economist at the Council of Economic Advisors. He's also now the president of the American Action Forum, and before that, in 2009, he served in a variety of influential policy positions. Doug, thanks so much for being on.
Well, thanks for having me. I really appreciate it.
So I think what's top of most Americans' minds is what they can expect on the inflationary front. What is it actually at now? Where do you expect it to be the next few months?
So the most recent report we got on the consumer price index was inflation of 6.5%, top line inflation in December. That's year over year. The core, if you ignore food and energy, because they tend to be volatiles, at 5.7, that's down from 6. And there's a lot of what I think of as premature spiking of the football because it's eased somewhat. But at the heart of that is the fact that energy prices fell at an annualized rate of 53% in December. And that's just not going to continue. And so I think a little caution is in order. If you look at the bundle of things that is food, energy, and shelter. So, you fill up your car, you go to the grocery store, and you go home. That is still rising at an 8.9% rate year over year. That's serious inflation. That means, every dollar you earn is probably worth 10% less roughly over a year. And at the heart of that is shelter. Shelter inflation was 1.4% in January of 2021. It is now 7.5%, and it has only risen, has yet to show any sign of slowing down. That's a third of most people's budgets. We have just a real problem there, and the Fed's work is not done. I mean, that's all there is to it. And so, if you watch business channels like I do, you hear all these guys saying, "Oh, the Fed should quit" and all that. I get it. No one likes what the Fed has to do to fight inflation, but no one wants to live with that kind of inflation. So once you get yourself in this position, you just don't have any great choices.
Yeah, and I want to talk about Fed policy and if they have one tool, and which is dealing with interest rates, and I'd be curious about the debate on that because I have other guests who say they've gone far enough at this point. The market has gotten the message, and now you're just forcing down inflation by causing a recession, which is not exactly what we want. But going back to the actual inflation numbers, you said you're spiking the football because you're seeing lower inflation rates, but that you said that was due to around a 50% decrease in energy prices year over year. Okay, so
I mean that's good news. We love it when oil prices come down in particular, and everyone was concerned about natural gas prices, particularly in Europe, they had a really cold winter in the face of the invasion of Ukraine and the cutoff of Russian natural gas supplies. None of that has played out the way people feared. And so those prices are softer than had been expected. That's great. I mean, that's all good news. It's just not enough good news. There's other things we have to deal with inflation.
Yeah. And where do you see energy prices going? I mean, just based on our production capabilities, it's something we fight a lot about in Republicans versus Democrats, of course, is energy independence, incentivizing investments in more production. Because the demand's only growing.
So, let's just stipulate it from the outset that the Biden administration was on the wrong page on North American energy, the great hydraulic fracturing revolution, that shale gas and oil in the U.S. And you can't reverse that overnight. So a lot of what we get stuck with is what happens to China. China has been literally in the tank. If China reemerges and starts growing at anything like previous rates, that's a huge demand for oil, and we see global oil prices go up quickly. And that's, so it all hinges on the Chinese economic recovery, and that's hard to predict. But I think it's more likely that it gets faster and more demand for oil than less. So I think there's pressure up on those prices. That's why we need to make progress elsewhere.
Yeah, on the supply side.
Yeah.
So let's have that. Maybe you could steal me on the other side's argument too, because I mean, there's smart people who say that the Fed shouldn't be increasing interest rates anymore. Their argument is that the Fed doesn't look at current data that the markets are really seeing in real time. The Fed gets outdated data. They make outdated decisions, and then they're always playing catch up, and they're going to play catch up again and have to rapidly reduce interest rates when we start causing a recession. There's probably a much more intellectual argument to be made, but I just sort of summarized it in layman's terms. You say the Fed really has to keep doing what it needs to do to get inflation under control.
So the contours of this debate aren't complicated. Basically, everyone has the same information. The notion that the Fed is somehow only able to use outdated information is not true. They have contacts everywhere in financial markets.
Yeah.
Same thing.
I agree with that.
That's not it. How broad is your vision? Well, most people have a sector they care about, or a company they care about, or maybe a portfolio. The Fed's got the whole economy. And in particular, right now, the pressure and inflation is in the services sector. That it's not all those things you heard about a couple of years ago. You can't get the supplies from overseas, supply chain stuck at the ports. That was a 2021 phenomenon. 2022 was services. And most of the cost of services is labor, and wage inflation is the primary problem. And we've not made any real progress in the wage inflation. I think that's what's driving the Fed. That's sort of point number one. Second point, and this is just a matter of how you think about it, the Fed believes that the only mistake that the famed Volcker Fed made a long time ago when we were fighting high inflation in the late 70s, early 80s, is that they eased prematurely. And so Chairman Powell said repeatedly, and they've been repeated by other people, that a bigger mistake is to ease prematurely than to do too much. And markets clearly disagreeing. They're saying, no, we think the bigger mistake is to do too much. So that's a matter of where you want to land in that debate. And then the third thing is, this Fed has said pretty clearly, we're going to declare victory when we see inflation come down. Whereas in the past, the Fed has basically relied on people like me, economists, and said, okay, if we've done enough, inflation will come down in 6 months. Tell us when that is, and relied on those economists. They've just said, we're not going to do that. That does raise the risk. They just keep going at a time when they could have stopped. And I think that's a fair point.
Yeah. And is their target still 2%? Is that still the
target? Still 2%. If you're going to push hard to get it down to 2%, you got to take that number that is shelter that's at 7. That's a third of the CPI. Everything else has to be 0 to get there. So that's not going to happen. So you really got to lean on the services sector and the shelter sector in particular.
Well, you said wage inflation is what's primarily causing this. Explain to us non-economists how the Fed raising its interest rate helps wages go down. What is the connection there, and how can, because what it does to most people, I know people in normal positions, is it just increases our mortgage rates and our borrowing costs. And I don't see how that helps with people, because the reason there's wage inflation is because people can't find workers. So are we trying to fix that? Because that's clearly a labor supply problem. And there's probably ways to fix that, right? From the policy side, the Fed has nothing to do with that. But I think people's worry is we're trying to fix that problem with an interest rate tool, and that interest rate tool has a lot of other second, third order consequences that may not even affect the wage inflation problem.
So I agree. So again, the big point to get here is the Fed doesn't want to cause a recession. It doesn't want to ruin the labor market, but it may in fact have to do so in the pursuit of lower inflation. That's the bind it finds itself in.
But will it even work? I mean, again, because if it's wage inflation in particular, like so what's the chain of events that occurs?
So here's the chain. Yeah. The good way out is always greater supply. It's the same as with oil. You had more supply, prices come down, more supply of labor. And the great mystery has been where the labor has gone. Like post-pandemic, we haven't seen the labor force come back. And I can't answer the question why as we sit here. That's a mystery, but it's true.
No one
So
can answer it. It's
right.
wild.
So it's unbelievable. So, if you can't have more supply, then you have to have less demand. And so you raise interest rates. It makes it, harder to borrow, to expand. And so you don't put the extra wing on the factory, and you don't hire the people to fill it. You don't expand your workforce and the office space does, because the office space is expensive. So you're just knocking down the growth in the economy, and thus the growth in demand for labor. It's not more complicated than that. The trouble is, as you said, the Fed has one instrument. The one thing it controls is the interest rate on overnight lending between big banks. And it just pushes that up and watches what falls out in the economy. That's a really blunt instrument. And the capacity to make a mistake is very, very large. There's no question about that. So it's just pushing and watching and hoping that the demand for labor goes down, the wage inflation goes down, and the top line inflation goes down. And it's hoping it can do that without causing a recession. But the reality is there is no guarantee that they can pull that off.
Yeah, that's kind of an interesting point too. And maybe it's been a while on this podcast since I did a Fed 101 kind of conversation. Okay, what the hell is the Fed? let's just be honest. A lot of people don't quite understand it. What is the Fed? What does it mean when they raise interest rates? And you just said it. It actually means they don't control what your mortgage rate is. They don't control what your lending rate is. They just what they're doing is, as you just said, they control the lending rate between banks, which then has a cascading effect with other interest rates.
Yeah. So if I'm a bank and it costs me 1% to get the money, and I can charge 2%, I'm making 1% on every loan. I go do it. If they make that the cost of that 2%, I got to move my rate up to 3 to make that 1%. And that's all they're doing. They're just pushing up every rate in the economy, whether it's your credit card or your auto loan or your mortgage, name it. They're pushing. And in the process, you're deciding, don't think I'm going to buy a car this year. Okay, so now we've knocked down the demand for cars, and we're not going to get as big a growth in the whole supply chain for cars. And that's how the Fed affects the economy. The biggest thing is right now is real estate. They have crushed the residential real estate market.
I've noticed.
Rates, mortgage rates are up. And if you stop buying homes, people stop building homes. And if you stop building homes, you don't put refrigerators in them. You don't put furnaces in them. You don't carpet them. You don't pave the driveways. You don't do a lot of things in the economy. And that's a real slowdown. That's what the Fed is up to at the moment.
Yeah, and we've all noticed.
Yes,
which is kind of why a lot of us are like, we've all noticed. Maybe let's at least taper it. Not saying bring interest rates down, but there's an argument for at least giving the economy a little bit more. And this will always be a debate, and how much the Fed should say, how much they should say about their plans, and I mean those minutes from each of those Fed calls just moves markets like crazy.
So for your listeners, just remember this chairman, I think, is the most plain-spoken, blunt Fed chairman in history, and even he announced their plan as, we want to get to neutral as expeditiously as possible. I can't tell you what neutral is, and I don't know what expeditiously means.
It's always stuff like that. Yeah, they're always saying that, right? It's always like he's completely open to interpretation. But just from a guy who likes to follow, again, a layman who's following real estate, I think the sense is that the market has gotten the message, and you need to let that play out for a little bit. But I don't know. A little bit more Fed won't. Well, go ahead. And I want to
say a little bit about the Fed and housing. I mean, because the Fed is actually doing the usual thing, which is raising rates, and that raises mortgage rates. And that has all these things that we understand. But they're really hitting the housing sector this time for a second reason. During the crisis, every month they went out and they bought $30 billion a month of mortgage-backed securities and pumped $30 billion of taxpayer money into mortgage finance. They're now taking $35 billion a month out every month.
Okay.
So that's a $65 billion swing in the amount of capital available to finance mortgages, either for residential or commercial things. And that's about a quarter to a fifth of the normal financing. So they have just hammered the housing sector. There's no question about it. And anyone who works in or near that knows it. There's a lot of the economy that's doing okay. We're not in a recession. If you're in housing, you're in a recession. I mean, they have really, that has happened.
Yeah, and that's interesting. And now, can we explain in layman's terms what it means. This goes back to Fed 101 because this is one of their tools. They buy securities and then they hold them, and then, like you said, they're on their balance sheet and then they're off their balance sheet. I don't think most people even understand what that means. Is there a plain spoken way to help us understand what you mean by that? First of all, what does it mean to buy mortgage-backed security? What does it mean for the Fed to have a balance sheet? How does that affect interest rates? Why is that a tool, et cetera?
So pandemic hits, and we can remember the Dow moving like double digits in a day, and financial chaos when it first arrived. So what's the Fed do? The Fed cuts rates to zero, just zero interest rates. It's fine. But then says that's not enough. What we're going to do is we are going to print $30 billion and we're going to go buy $30 billion worth of mortgage-backed securities. And so they've now.
First question, what does it mean to print money?
In the old days, it literally meant print the money. If you look at a dollar bill, it says Federal Reserve note. So you print the money, and they can do that. Now they do it essentially electronically. They say to a bank, you now have $30 billion credit at the Fed. You can go do with it what you want. So they can go lend it out. But they print $30 billion and they dump it into financial markets. In return, they now have $30 billion of these securities, and that's called their balance sheet. That's an asset for them. They can then go sell that later. So when you hear about the Fed balance sheet going up, it went up by $5 trillion during the pandemic till they stopped buying. That means they pumped $5 trillion of cash into financial markets. They wanted easy money for anybody, and they produced it. They also produced a lot of inflation. So they're now doing the reverse. They're taking it out, but that has implications. No one likes the inflation, but no one likes not being able to get their hands on a mortgage.
Do you think that was a mistake in hindsight? Because as a specifically mortgage-backed security, so it's specifically the housing market. I mean, what was the point of pumping up the housing market during the pandemic?
No, it was never.
You think it was a mistake?
I think it was a mistake. In 2020, in the spring of 2020, when the U.S. economy, it literally contracted by 10% in a single quarter. The worst year of the Great Depression was 12%. So spring of 2020 was terrible. I get it. They did the right thing. By 2021, it was over. They should have stopped, and they didn't. They just kept they had their foot on the gas, and they're pumping this cash in, and they overinflated things. And housing markets, exhibit A on that, and it was a mistake.
Right. So again, I know maybe I'm hammering this too much, but I like to bring things down to a very simple understanding. So printing money means they just say either it could be a couple of things. It sounds like it could be just telling the bank, look, you have this. Because banks have what is it called? They have a ratio that they have to abide by, right? About how much money is deposited versus how much they can lend out. And so what the Fed does is say, we just basically change the ratio for you, so you can lend out more. That's effectively what printing money is. And then you're saying too that what the Fed can do is buy or just say that they're basically just declaring that they now own this much money in mortgage-backed securities.
Yep.
But explain what a mortgage-backed security is.
So I have a mortgage, you have a mortgage, and the bank takes those mortgages and says, I don't really want to have to deal with these anymore. And it sells our mortgages to Fannie Mae, Freddie Mac, and they bundle all those mortgages together. And they say, if you buy this thing called a mortgage-backed security, you get a share of every single mortgage that we put into this package. So it's really just taking all the mortgages and putting them in a big container and seeing what mortgage payments come out and giving investors a share of those mortgage payments. So I'm paying mine, it goes into the pool, out it goes to the people who have mortgage-backed securities. So it's a way for banks to not have to pay attention to every individual mortgage. They can make the loan and then hand it off and let someone else deal with the lifetime of collecting mortgage payments and dealing with those who get behind and things like that.
Right.
So this is a very effective financial tool. The Fed chose to use that thing. It could have used stocks. It could have used anything. It chose mortgage-backed securities to be the vehicle by which it dumped all this cash into financial markets. And that had consequences. I mean, it certainly favored the mortgage industry over others for the duration of their intervention. And
maybe that's why they're targeting it again now.
And now they're undoing the favor. Yes, that is for sure.
And I think this gets to a lot of complaints about the Fed is it feels like it's always this whiplash. It's always this up and down, this severe troughs and what's the opposite of a trough? Peaks. Sorry, haven't had enough coffee. But I think, and I think it frustrates.
So So
critics.
that's actually important because in the end, the Fed people are people, and they're sensitive to that, and it's actually an issue right now because they said the inflation was transitory. They said, "Don't worry about this; it's going to go away," and they were wrong, and so they had to change course. Now they said we're going to stay the course until the inflation is gone, and people are telling for them to reverse course. They're like, well, if we do that, then no one's ever going to believe anything we say. We have to stay the course to prove that we mean what we say.
Well, we just want them to do what works.
That's part of the bind that they put themselves in here, right? I mean, they're sort of stuck.
It's wild because I wasn't exactly informed on what you just said about the mortgage-backed security buying. It makes no sense given the economic situation we were in 2020 going into 2021, where the reason that you have a recession is well, it's really obvious. It's the pandemic, but it's the government removing all demand and also cutting off all supply. I mean, doing both, shutting down things has that effect, and making mortgages easier to buy doesn't help that at all. Like you don't have to be an economist to know that.
No, you don't. And if you think back, and it's always surprised me that there wasn't more attention paid to this. The housing market went crazy in 2020. People kept saying, "Oh, everyone's moving out of the cities and stuff." Well, part of the reason was the Fed was just pumping it up. I mean, they were.
Yeah, best time to get a mortgage ever, right? Interest rates were basically free. Okay. Well, I guess we'll get off Fed 101 for a little bit.
Okay.
Well, actually, no, we won't. Hold on. So, one more question about Fed 101. Quantitative easing. Is that effectively the same thing that we're talking about?
It is. It is the purchase of the mortgage-backed securities and other things. That's what that's called.
Right. And let me explain this and see if I've got it right. The whole point is you're buying these, whether it's mortgage-backed securities or bonds, and then this is a different way to drive up or drive down interest rates.
So you go to quantitative easing when you've already got interest rates at zero. So if you can't do any more interest rate policy, you go and do quantitative stuff, not price stuff, quantitative stuff by just buying the securities directly, dumping the cash in financial markets. These are all ways to have easy money. Make it cheap to borrow, or just give them the money. I mean, it's not complicated.
Does the taxpayer make any money off of this? So if they're getting rid of the mortgage-backed securities on their balance sheet right now, is there a profit made by the Fed?
Not right now. In the past, like they've make a lot of money on their purchases of things, and they donate typically something like $50 billion. They sweep the Fed's profits and put it in the Treasury every year. Right now, they're losing money on their portfolio as they dump this stuff off. They're selling it for less than they got, and so that's not available to the Treasury.
Well, this is all going really well. Then it sounds like
I'm the perfect guest. I mean,
so we're losing money. We're potentially pushing ourselves into a recession. Okay, well, here's a very simple question. Plenty of forecasts out there on the possibility of a recession. What do you think?
We are not in a recession, not now. So that's overblown. If you hear that, that's not true. Mm-hmm. There are sectors of the economy that are real weak. That's housing and tech. The rest of the economy is hanging in there pretty well. I think the chances of a recession by the end of 2023 are above 50%. And the reason I say that is that the Fed has in the past tried to reduce inflation and not have a recession. That's called generating a soft landing. But it's never been successful when inflation has been above 4 and unemployment is below 5. Well, that's where we are. So the historical record is against them pulling it off. That's all I know.
Okay, so if we wanted to pull it off, then what at least could we do in Congress to have that softer landing? What should we be pushing for? I mean,
I actually don't think Congress should be doing anything on that front right now. I think
just general fiscal policy, regulatory policy. Right. I mean, if you were king for a day, what would
my concern? My concern is not the mild recession that we're likely to have at the end of this year, which the Fed can easily undo by lowering rates. That'll be fine. And if they're smart, they'll lower in advance and run it off, and that'd be even better. I'm worried that after that, there's no strategy for growth, that this administration just does not have the belief that it's time to hand it off to the private sector and let it grow, or the willingness to get out of the way, to reduce the regulatory burdens and to let markets actually operate. They've hamstrung energy markets. They are busy issuing regulations at an astonishing rate, like no other administration in history. And regulations are just hidden taxes. And they put $200 billion of regulatory costs in their first year. They ran in another 100 in the second year. And if we had a debate in Congress that said, do we want to raise taxes by $300 billion? I'm pretty sure some people would say, I'm not so sure that's a good idea, but they're doing it. And so how are we going to grow? Like, what's the strategy? That's what I'm worried about. What do we do past the near term so that over the next 10 years and for the next generation, this country delivers growth and prosperity? That's the primary challenge for Congress.
Right. And to be more specific about our obstacles to growth, you've got the interest rate part, because you got increasing interest rates is literally trying to inhibit growth. Okay, it's on purpose. You've got a labor supply problem. Nobody knows where workers went. I talk to businesses all the time. They don't know. I'm like, somebody's got to do a study. So maybe you can get some funding to do a study and ask businesses, okay, who used to work for you? Where are they now? And then call them and ask them why they aren't working there anymore. I mean, I would really love to know, like, just do a broad survey where these people are, because every business says the exact same thing. And they literally don't know where people went. They're not even trying to grow very much. They're really just trying to sustain their current demand.
I agree.
So it's mind blowing. There's obviously some obvious, I think, there's some obvious reasons, right? Which is benefits. Are we giving out too much benefits? There was just a study released that I can't remember. It was like 27 states where the median income was basically the same as if you were on welfare. That's crazy. That's got to be an inhibitor to growth. Curious what your thoughts are on that.
Well, if you systematically raise the return to not working, people are going to not work, and we've done that. We did it in the pandemic. We did it prior to the pandemic. This administration has done it administratively post-pandemic. They've done some things that I don't think they should have been able to do. Like, they raised food stamp subsidies without a vote in Congress. It's unbelievable.
I think they like tripled, actually. This is another thing not a lot of people know. I mean, I think the amount we spend on food stamps, I think it tripled. Doubled at least. It was huge. I remember seeing the numbers. It was a huge increase.
It's a big increase. So on every margin, they're pushing to make things more generous. They're trying to keep the people currently on the Medicaid rolls, even though they shouldn't be eligible for Medicaid. There's a lot of that going on, and maybe no single one is the answer. But if you cumulatively tip the balance between the return to working and not working in favor of not working, people won't work, and that's not complicated.
Yeah, and it's we can do what we can at the congressional level. But a lot of this does happen at the state level. That's why I said, in 27 states, you look at them, and they're mostly bluer states with very generous welfare benefits, and people can figure that out pretty quickly. People are economic actors and look out for their best interest.
They do.
I don't think that's in their best interest not to work. I think that screws you in the long run, but maybe some don't think that way. Yeah. Well, and then I think, the third obstacle to growth is, obviously, you mentioned it, on the regulatory front. If we just take a step back, let's say Republicans finally had the House, and let's say we had 60 votes in the Senate. I mean, wouldn't that be something? And a president who was a Republican. And we made it a key effort to just untangle the regulatory mess that our system is. Where do you even begin? How difficult of a problem is that to roll back regulations that have gone through the process and become the norm? And where should we start?
So the Obama administration finalized a, quote, costly major regulation, something that costs more than $100 million to comply with, at an average rate of 1.1 per day every day for 8 years. Total burden, $890 billion of regulatory costs. So that's over $100 billion a year in stealth tax increases. Wow. And the Trump administration in the first year did $5 billion of regulatory costs. And the second year did negative 15. So how does that happen? That's just miraculous. I actually didn't think they could do it, and they did it. You know what they did? They gave the agencies a regulatory budget. They said, here's your budget. You can raise the cost on American businesses and households by this much and not more. And if you start to go over that, you have to get rid of some regulations and hit the budget, which is not saying you know everything about the regulations. You let them decide, but you got to be disciplined. And it worked. Most of those budgets were zeros or negative numbers. It said you can't raise it. No more. And they,
But
and
Can
the
they
agency
screw,
did it.
can they screw around with how they measure the cost of a regulation, or is that formula pretty set in stone?
Standardized by the Office of Management Budget. They have rules on how this is done. So I think the right thing for Congress to do is to make that the law, right? You could not have the president do that. You could make it the law that an agency has a regulatory budget, and here's the budget for this year. And then they would have to manage to that budget, and they would control the regulatory costs. That's the single best thing Congress could do.
What if they came back and said, well, it's your statutes, Congress, that require us to create this regulation? And I wonder how we would sort that out. It is true.
It's true. No, it's true. You have to implement statutes and they require regulations, but they don't right now say, okay, what's the cheapest way to implement this statute? Regulation is the cheapest, which is they don't go to the business community and say, hey, what do you think? We need to do this. What would work best? They impose these things in a pretty arbitrary fashion. They're expensive.
Right.
They're unworkable.
They want to reduce all liability too. I mean, they want to reduce their own liability, cover your ass kind of politics. Yeah.
So if you have a budget and you haven't got much room, you go to the business community and say, look, we can only do about $50 million of cost. Is there a way to get there? And they'd be like, we already do this. Let's just do this. It's not an abstract. The Trump administration actually did it. So it can be done. And they didn't stop having laws. They didn't stop protecting the environment. They didn't stop protecting people's health. They just did it more cheaply. And that was smart.
Yeah. Maybe last question before we got to wrap up on the debt ceiling. You've urged caution in approaching the debt ceiling. The Republican stance is essentially, you got to come to the negotiating table, Biden. We have to have brakes on our spending somehow. Of course, we don't want a default on our debt. People should always distinguish between a default on the debt and shutting down the government. Shutting down the government, sure, it's no big deal. It's some heartache there, but we've never defaulted on the debt. Am I correct about that?
That's correct.
And we're not even sure what would happen. It probably wouldn't be good. So give us your thoughts on that.
Would be
how we should approach it.
So first of all, there isn't any disagreement about the desirability of honoring our obligations to pay interest and principal on treasuries. No one wants to default. That's not a point of disagreement. The disagreement is over the spending habits of the federal government. And people need to understand that. It isn't like Republicans want to default, Democrats don't. Right. No one wants to default. But there has to be an agreement on the spending to go forward. And so that's point number one. Point number two is to say you're not going to negotiate is a negotiating position. So the administration is already negotiating. They just have to get to a serious point on these negotiations. We've seen this in the past.
Right.
And, I think the most important thing is step number two. Step number one is get some sort of agreement. But my reading of the history is that we've raised the debt limit or suspended it and done it in a clean fashion. And we've done it with some language that says we're going to really not do this again. And the outcome has been about the same. We haven't genuinely controlled the growth of the debt in the 21st century. It just keeps going up. So to me, whatever agreement is reached this year is step one. Step two is a more permanent realignment of things so that we actually do stop spending so much. And that I hope people realize, because we've had the big victory once or twice before, and it didn't turn out to last. We need to get something lasting.
And I'm not even sure Republicans have gotten together yet and decided on what we should do to put brakes on spending. I mean, one of the frustrating things for me watching, especially our first 2 weeks of the year, everyone saw that play out. And one of the frustrating things for me was that was yet another giant fight, even though, well, it was a fake fight because the agreements had already happened well before all of the speaker votes. And I put out a podcast laying that all out last week. But let's pretend that the fake fight was about discretionary spending, right? Going through regular order, getting at least having a goal of achieving a balanced budget within 10 years, but only according to discretionary spending. And how much of our spending is discretionary spending? I don't know what those current numbers are. How much?
It's about 30% of it.
About 30%, and about half of that is the Defense Department. Yep. So you're really only about 15, and we're not cutting the Defense Department no matter what. Maybe not grow it a huge amount, but we're not cutting it. So then you have about 15% to play with, which really means you got like 2 or 3% that maybe you could shave off. So you're really not talking about much money.
Right.
So what's that other 70%?
That would be in the parlance of budgeting mandatory spending in the real world. Those are the entitlements. That's Social Security, Medicare, Medicaid, Affordable Care Acts, all of those things. The programs that aren't voted by you every year, but are on autopilot, have been created and just go.
Right.
And that's where the money is. And it's not that you have to, people always portray this as you're going to cut Social Security or cut draconian things. That none of that's true. You just have to make them grow more slowly. And that can be done. And that should be done.
I said it openly a million times. The Social Security is a math problem. That's a little bit easier to solve.
Easy.
But it's still a political. It is. I mean, even talking about it, boom, you've got ads. You've got Democrats running ads that you're going to cut Social Security. But if you poll people and you say, well, should millionaires get Social Security? No. Well, okay. Well, you know who else thinks that? The millionaires. Because we talked to donors plenty. And it's not crazy to say that there should be some means testing with Social Security. The entire point of it is to keep senior citizens out of poverty, right? Yes. Because they can't, on account of the fact that they can't work anymore. Now, right. And another question. And so I don't view this as a left-right issue. I view it as a generational issue. I view it, no offense, as my generation versus your generation.
Yeah.
And my generation is going to get really screwed here. And so what pisses me off is that, one, the quote unquote budget hawks only want to talk about discretionary spending because it gets them more headlines every year. And they're deathly afraid of their own voters when it comes to talking about what actually is driving our debt. Yeah. And me as a representative of the millennial generation, and I guess Gen Z, but I'm not Gen Z, obviously, but let's just say I represent younger people who know very well that the Social Security is going insolvent. We have to do something about it. It really pisses me off that this is just a political football. And I don't think that I should retire at 67. I think you should raise my retirement age to 75. Personally, I think I'll be fine. And that would save us a lot of money. But I also don't think that it's fair that you should raise my taxes. So Bernie Sanders wants to raise the cap. He just tweeted about it this weekend. He wants to raise the cap, and he says the reason is because a billionaire pays the same amount in Social Security as somebody who makes $160,000 a year. He is 100% correct about that.
Yep.
Now, does that mean? But let's talk through that actually real quick, if you don't mind. I'm sorry to make this a Social Security conversation. I know you only got a couple minutes, but maybe let's end there and then move. We'll call it a day.
So number one, it has always been the left that insists on the program being quote universal, right? They're the ones who want the millionaires to be in. It is their belief that having the millionaires in keeps the program in better shape. I'm not convinced that's true because it's in bad shape. Number two, it is correct that I am the problem. I'm the trailing edge of the baby boom generation. I've always said the goal of Social Security reform should be to get Doug Holtz-Eakin, because if you don't get me, you have grandfathered the problem. The baby boom is the problem, and so you needed to do something, and that hasn't happened. It's a huge disappointment to me. So now the problem's harder because the boomers are retired and they're getting their money, and it makes it tougher. But you can't just solve this on the tax side. I mean, you can collect more revenue, but that has consequences. Taxes always have some consequences. They're going to fall on the people who are working. Why is that fair? I get to keep all of my benefits and not contribute to solving the problem while you pay all the taxes? That's not right. This is about across the generations making this thing sustainable, and that means that affluent retirees, like I will be shortly, should be participating in solving this problem.
Yeah, and that's what makes me so mad about Bernie's proposal, and it makes me mad that young people support him, because he's literally saying we're going to tax young people more, and we're going to transfer that money immediately to your grandparents who never had to pay that level of taxation. Yes. And by the time people are living really long. I mean, I'm not sure what the calculation is. It depends on a lot of factors and how much they paid into the system, but the reality is more and more people are getting way more out of the system than they put into it in the first place. That is just a numerical fact. And if we don't talk about this, we're just not being honest with our voters. And this is a problem, but it's a problem that won't get solved today. So, Doug, thanks so much for being on. I know you had a hard stop in about 5 minutes, but I think we got through a lot. So thank you.
Happy to do it. Thanks for having me. I really appreciate it. Best of luck.